Taxation is always a tricky subject, and if you are a mutual fund investor and are confused about some or the other taxation rule, then watch this video till the end as we are going to cover A to Z of the taxation of mutual funds in this video today. Hello and welcome to our channel 5 Minute Finance by ET Money, where we talk about the basics of personal finance. We have two other channels, ET Money Hindi, where you can watch all these videos in Hindi. And if you are looking for analytical and slightly advanced investing topics, you may check out our channel ET Money. Let's get started. So, an investor gets two types of income from mutual funds. First is capital gains. Capital gain occurs when you sell your mutual fund units for profit. For example, if you bought a mutual fund unit for 10 rupees and sold it for 30, the difference in buying and selling price, that is 20 rupees, is your capital gains. The other type of income is dividend income. Just like shares, mutual funds also declare dividends depending on the accumulated gains. Such income distributed is taxable. The taxation of both kinds of incomes, capital gains and dividends, is different. Let's understand how. The taxation of capital gains or profits depend on two factors, the type of mutual funds and the holding period. First, let's understand what we mean by type of mutual funds. There are different types of mutual funds, equity, debt, hybrid, international, and so on. But for the taxation purpose, mutual funds are classified into only two categories, that is equity and other than equity, or what we call as debt. So, for taxation purposes, any category of fund will follow either equity taxation or the other than equity taxation. Now, any mutual fund that has invested at least 65% of the assets in Indian shares and equity derivatives during the year are considered equity-oriented funds. Rest everything is classified as other than equity or debt-oriented funds for taxation purposes. So, going by this rule, the funds that invest in international stocks will follow the taxation rules of debt funds, despite the fact that they are investing in foreign equities. Gold funds are also taxed as debt funds. What about hybrid funds? Well, the equity and debt allocation in these funds decide the taxation. Next, we come to the holding period, the second factor to decide taxation rules for mutual funds. The holding period decides whether gains are long-term capital gains, that is LTCG, or short-term capital gains, that is STCG. And the definition of short-term or long-term holding period also differs for equity and debt funds. Look at the table on your screens carefully. So, in case of equity funds, gains are considered short-term if holding period is less than 12 months. And if the investments were held for a period over 12 months, the gains are considered long-term. In case of other than equity funds, the holding period has become irrelevant as currently both long-term as well as short-term gains are taxed in the same manner. But the rule is different for debt funds bought prior to April 1, 2023. So, for investments made in other than equity funds, before the beginning of this financial year, gains on investments sold after 36 months of holding were considered as long-term capital gains. And the gains on investments held for lesser than 36 months were considered short-term. Hope it's clear. Now, coming to hybrid funds. Well, if it's an equity-oriented hybrid fund, it will follow the rules of an equity fund. And if it is a debt-oriented hybrid fund, rules as applicable to other than equity funds will apply. Now, before we move on to the taxation part, I want to discuss something crucial with you. While we keep on talking about investing, it is extremely important to plan for the shocks in our life which can be a drain on your finances. One such shock could be medical expenses. So take adequate health insurance cover. ET Money offers a 1 crore health insurance plan to take care of your medical expenses for your whole life. It is extremely affordable and starts only at 987 rupees per month. And the best part, the premiums do not increase till your first claim. So after watching this video, make sure to check it out on the ET Money app. Now let's get on to how the capital gains on mutual funds are taxed. In case of equity-oriented funds, short-term capital gains are taxed at the flat rate of 15%. So suppose your short-term capital gains were 1,20,000 rupees. Then tax will be at 15%, that is 18,000 rupees. The long-term capital gains will be taxed at the rate of 10% on capital gains exceeding 1 lakh rupees. That means for gains up to 1 lakh in a financial year, there is no tax. Now, for example, if your long-term capital gains on an equity funds are 1,20,000 rupees, you will be taxed only on 20,000 rupees worth of gains. From April 1, 2023, all gains arising from other than equity funds, irrespective of their holding period, will be added to investors' income and taxed according to the applicable slab rate. Prior to this, debt funds enjoyed a tax advantage. The long-term capital gains on debt funds enjoyed indexation benefits, where such gains were adjusted for inflation and taxed at a rate of 20%. This rule will continue for funds bought before April 1, 2023. So to be clear, investment made in debt mutual funds before April 1, 2023 will enjoy the earlier tax treatment till redeemed. This means if there is a long-term capital gain where you held the investment for at least 36 months, it will be taxed at 20% post-indexation. Let's understand this with an example. Suppose you invested 1 lakh rupees in debt mutual funds in February 2019. Its value increased to 1,35,000 by February 2023. You decided to redeem the funds. Now, to ascertain your gains, we need the CII values, that is, the cost of inflation index for the year 2019 when mutual fund units were bought and year 2023 when the mutual fund units were sold. The CII index values are provided by the tax department and are available publicly. So for FY 2019, value was 280 and for FY 2023, it was 331. Now the indexed cost of acquisition will be 1 lakh rupees divided by the CII of 2019 multiplied by the CII of 2023, which comes out to be 1,18,214 rupees. So for taxation purposes, the indexed purchase price will be used. Now the gains will be 1,35,000 minus 1,18,214, which comes out to be 16,785. And tax at the rate of 20% comes out to be 3,357. Now, the short-term capital gains will be taxed as per slab rate only. But if you have invested in debt funds on or after April 1, 2023, you will have to pay tax as per your income tax slab, irrespective of the holding period. Investors have to pay tax on the dividends from mutual funds. They are added to the income of the investor and taxed as per the slab rate. With this, we have come to the end of this video. If you liked it, please hit the like button and subscribe to our channel. Please share this video with your friends as well. Thanks for watching.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.